Fascinating, Kyle. It's interesting to see, equities mirror the public market, but also to see the real estate tokens take such a jump during this time. It's definitely no coincidence, I think. And I think that's a great segue into our main topic. At the end of the day, what we're trying to compare here is if we were to look at public markets, more than ever today, retail investors are able to participate. It's digitally accessible, and the exchanges are mostly built on electronic trading at this point. And so you see extremely volatile markets recently because everybody is trading, of course, due to the coronavirus epidemic across the world. And we think that by analyzing this, we actually think we can learn a lot for digital securities in the future, both for private and public markets. In fact, we think that perhaps the private markets will elicit similar behavior in the future when digital securities are more prominent and are able to share those same characteristics and trait as publicly listed securities. So with that, I think it's a great idea for us to cover a segment on how we see digital securities speeding up and making both private and public markets more efficient as a whole. So maybe, Kyle, why don't you kick us off on how you see that?
Yeah, so there's a couple ways that we can look at how to speed up the digital securities, or how digital securities speed up markets, rather. And so really what we're looking at is removing friction. And that can result in two potential benefits. One being it saves money, and one being that it speeds up the process literally with time. It saves time. And so both of those things are crucial, especially for financial institutions, to save money as well as to speed up the process, which also can help save money. It also allows them to scale their operation even more effectively. So when we're talking about removing friction, this is slightly more intuitive with a lot of these early cases. The first one being transferring asset information across multiple third parties, right? So if you have a security in a specific jurisdiction, they're going to need to transfer all the information regarding what the underlying security is and what the information of that asset is to all of the different intermediaries along the way. So that requires a lot of hand-holding, right, in terms of sending all this information, all the documentation, all the filing regulations, and all of that stuff from one person to another. So by leveraging that through the blockchain technology, it makes it much easier to send that information across, and it also makes it much easier for the other parties to verify that that information is correct and that this hasn't been altered in any way. Additionally, another huge one is onboarding investors, right? Being able to make sure that we've properly done the right KYC, AML, and accreditation checks for a specific investor in their jurisdiction. Now, it's a lot less requiring on the centralized third party to manage that process and make sure that it's done compliantly. Instead, by leveraging distributed ledger and digital securities, they can actually just transfer that information systematically. But the biggest one that we want to talk about today, the one that saves the most money and the one that certainly speeds up the markets most effectively, is integrating the technology layers. And so when we talk about that, really what I'm talking about is regarding programmatic settlement via smart contracts. And so first, let's go through what that means. So in terms of a traditional financial sector, we have the clearing and settlement piece of a financial transaction. And so essentially when we have two parties, let's say an issuer or somebody with an asset, and we have an investor or a broker, somebody with the money. When these two parties want to make this transaction between each other, both are taking on risk that the other person is not going to send their fair share of the deal, right? The issuer doesn't want to issue their security or their stock without getting their money first, and vice versa. The investor doesn't want to send their money and not get the asset that they paid for. So the solution was to create a centralized third party that would do what's called clearing and settlement. And so they would clear the trade and then they would settle the trade on the other side, and they would be that third party where the issuer could send the money to, or the issuer could send the asset to, and the investor could send the money to. Once both of those things were confirmed by the clearing and settlement third party, then that transaction would be confirmed, and then each side would get their respective good. And so this is a traditional process. Obviously, we need this because we needed to find a way around solving that trust problem. And this process was very similar to what we've seen in assets like Bitcoin with its consensus mechanism through mining. What happens with these centralized organizations is that they actually do blocks of transactions and then settle them all together. So they may collect tens, thousands, or potentially more trades at any one time and then try to settle all of those transactions in one go. That way it makes it much more efficient for them because they can collect a bunch of trades, just quick clear them all, and then collect more trades and then quick clear them all. So it's more efficient for the third party to be able to get this done in a cost-effective manner, but it's not always the most ideal solution for the two parties, the issuer and the investor, because they actually have to wait in that time period while the third party is collecting other people's transactions. And so this bulk process is actually not as effective as an automatic clearance, which would just kind of take care of all this stuff immediately once the issuer and investor participated and engaged in a contract. And so that's what we can actually start to build with smart contract construction. And so smart contracts really are just a series of very, very complicated if-then statements. So we're essentially saying if an issuer sends us a specific asset, and if an investor sends us a specific amount of money, and if the issuer and the investor agree on that specific price for that specific asset, then we send the money to the issuer and send the asset rather to the investor. And so it essentially is just a very complicated if-then statement that does exactly what that centralized clearinghouse might have spent most of their time doing. Now, it can be created by that centralized issuance platform or by something else as well. But this removes a lot of that counterparty risk of the payment failing after the transfer of the stocks and is therefore much more efficient, right? Because the issuer themselves doesn't actually have to send that asset until after the funds have been received in an escrow account to be confirmed that that money's there. And then on the other side, the investor doesn't need to pay without seeing that the asset is in a specific escrow wallet that doesn't get unlocked until after they pay. And so both sides can be sure before they actually issue or sell or risk any of their asset, they can actually see that the other side has been confirmed, and therefore they don't have to feel like they're getting defrauded or risked without having to spend that extra money on someone taking their cut. It also reduces delivery versus payment times, and this is a really common figure to look at in the traditional settlement and clearing sector. And the traditional settlement time for a public stock is 2 days. So essentially what that means is that the intermediary third party does not need to settle the transaction for 2 days following the actual transaction and when it was agreed upon. And so maybe when you go on TD Ameritrade and you buy a stock, you buy it, you click it, and 10 minutes later it gets executed and sent to you. But that's actually just a front layer. That's the electronic layer. And you actually don't know whether that's fully been secured and settled or not yet. That's up to the brokerage, that's up to the different assets and how much opportunity they have and how many of those assets they have in reserve. So because of the fact that we have up to a 2-day settlement period, we actually have very complicated derivative ladders that can be very confusing for brokerage firms, because what they'll do is you'll buy a security, but then they'll actually short your security for you without putting the risk on you. They take the risk, but then they can actually short and long one asset like 3, 4, 5 or more times so that it's actually technically owned by many different people. But when you don't settle those transactions immediately, now you have to settle specific transactions that don't technically exist because you've already lent these things out and created derivative products. And I don't know if you followed that at all, but as you can hear, it can get very complicated, especially once you start to incorporate all of these derivative products and reassigning ownership behind the scenes. It can be very complicated, and it can become quite an issue if this process isn't handled automatically, because you take the risk of someone making a mistake or some human error, which could really have serious issues. So programmatic integration here is going to be a crucial piece to be able to settle these things automatically and track on the ledger exactly who owns what, so that you can literally just go in and check, especially from a third party, even if it's a private blockchain or something like that. They can go in and check exactly who owns what, and they don't need to be there to actually facilitate every specific transaction. And so this process also includes the electronic money transfer and the transfer of assets from one custody provider to another, all of which take time and have added fees and are much less preferred to the cheap gas fees on a distributed ledger technology system. And so this is traditionally managed by a custody participant or a transfer agent, but the programmatic integration into this piece of the financial system allows for cost savings on the basis point per transaction level, in addition to much faster settlement times. Because really we're talking about hundreds of millions of dollars, if not more, that are happening each and every day in the markets. And if you can save just 5, 10, 20 basis points on each of those transactions, you're talking about so much cost savings for those banks and those institutions just by leveraging this technology. And then on top of that, by adding automatic integration and programmatic settlement, you're talking about a much quicker process that not only happens immediately due to the execution of the contract, but it also happens much faster because we're leveraging technology to settle these things instead of relying on human input. So in both ways, it makes this market much quicker, much more efficient, and can save so much money for everybody. And so it doesn't come without its own set of challenges, which include the risk of the soundness of the smart contract, which makes sense, right? We need to make sure that the contracts we're building don't fail, right? That they're bulletproof and can handle trillions of dollars of assets being exchanged on that specific set of code, which again highlights the value of sandboxes with regulators. It highlights the value in testing these things for large financial institutions that have the resources to be able to test these things without launching. It also highlights the impact of the important conversations that we need to have between the innovators, the startups, as well as the institutions and the enterprises, and then finally the regulators. We all need to be in communication, all need to be working together to build a system that can work well, because in the situation where this goes live and it works for everybody, everyone saves money, everyone saves time. It's easier for regulators to policy. It's easier for institutions to settle these things, make more money, and it's obviously helpful for the innovators who are able to expand into new opportunities and build the industry even larger. And so there's some risk there in terms of the smart contract. The other piece of risk I think is important to note is there's displaced clearing risk due to the lack of liquidity without the traditional bulk settlement. So that bulk settlement I was talking about earlier, where they collect all of those transactions and settle them all at one given time, is known as netting. And that's important because let's say I buy $1 million worth of assets and I sell 500,000 of the same asset. Technically, they only need to clear 500,000 since I netted out 500K in what I sold. And so I don't need to have $1 million in liquidity. I only need to have 500,000 in liquidity. And so that's a lot of times the benefits of netting, is that they can actually reduce some of the liquidity concerns or costs for these large brokers. With automatic settlement, if I put in a trade for $1 million, I'd need $1 million in liquidity, and then I would get that 500,000 back. So it can cause some risk there in terms of liquidity risk, but that's something that we would just need to make an adjustment for, and I don't think would actually affect a whole lot, because those short-term lines of credit for these huge brokerage firms is very easy as well. They could absolutely do that without any issue. So that was one that I'm not super concerned about, but it is super important to mention because it's a displaced risk from what we've already talked about with that netting process. And with that, Herwig, that's kind of what we're talking about in terms of improved efficiencies in the market. We're really talking about settlement and clearance and how that can be leveraged and built by distributed ledger technology.
You really highlighted the ecosystem, that's been built today, and specifically how blockchain technology and smart contracts are going to improve the markets themselves, even highlighting in some very technical and detailed examples. So I'm sure hopefully our listeners appreciated that. But I'm going to try and summarize a little bit here to try and make it a little bit more anecdotal, which is, as you pointed out, we spent 100 plus years with the SEC and markets to form, and the public markets to become both efficient as well as balanced with investor protections. And this is why we've seen the need for additional intermediaries every step of the way, whether it's from compliance, whether it's from custody, whether it's from a governance perspective, or whether it's from the actual function of clearing and settlement. All of this is correlated, and all of this is one big transactions with many, many transactions associated, many transaction to check the compliance, a many transaction to approve the transfer, to update the ownership records, etc. And by using digital securities infrastructure, we can take the very manual and let's call it, bulky process that has been created for the public markets, and now bring that completely digital and online, which is a incredible disruption, and even more so not just for public markets, but also for private markets, because they can leverage the exact same technology. And as a result, we may see very fascinating changes occur to private assets like real estate and other categories that traditionally didn't quite have that level of liquidity or potential, or because they weren't at that scale on the public market. So this is, to me, a very important segment that we did, Kyle. I think the only thing that I would like to add to what you said here is that this truly shows the value proposition of blockchain. Without blockchain technology, none of this would be possible, because we need to be able to remove that concept of trust, where we have an immutable programmatic system that we are able to track, that regulators are able to tap into, that investors and issuers are able to leverage for protection in the court of law, but ultimately is the digital version of what we do today. And it's only because of blockchain technology that this entire infrastructure can be developed and connected and function in the same regard that it does today on the public market world. So very, very exciting stuff, Kyle. Thank you for that great feedback. I think we have plenty more segments we can do on the subject. We haven't even tapped into how, dividends, for example, can now be simultaneously executed thanks to programmatic smart contracts. Coupon distribution of debt and things like that are now entirely done more efficiently and on chain. And the fact that we can now tap into wider accesses of investors in an even more globally connected world, what that might do to capital markets is definitely an interesting topic in itself. So lots more stuff to be talking on the podcast. For those of you who are self-quarantining, we have 34 other amazing episodes that we'd love for you to check out and listen to. And with that, please always feel free to reach out. We are very active on Twitter, LinkedIn, and our social medias. Give us feedback, give us content. If you want to contribute to the show, you can go to stomarket.com/news, or you can submit information or even comment on some of these articles that we're talking about and engage with the community. And I think with that, I want to thank everyone for listening and wish everyone to be safe out there.
Thanks again for listening. Talk to you next week.